St. Louis Fed President Jim Bullard is the interview I'm talking about. He said he supports raising interest rates by a full percentage point between now and the start of July. By July 1st, he would like to see 100 basis points in the bag. That's the direct quote. He said, "I was already more hawkish, but I've pulled up dramatically what I think the committee should do." And a lot of the other quotes were, I think, even more striking. Let's dig deeper into the inflation data right now with Yelena Shulyatyeva, senior U.S. economist for Bloomberg Economics. Yelena, what struck me was that Bullard said, there was a time when we would have moved now on this and done something immediately. Was that a little bit of a slight that the Federal Reserve isn't moving quickly enough?
Well, look, they also still adding accommodation through the balance sheet. So it would be really interesting to see how they hike rates and continue to buy assets. So I guess they will just move more aggressively in March, and that's what the latest data are telling us. They may seriously consider a 50 basis point hike in March, and they will perhaps move at each and every meeting after that. So today's CPI report pushed the probability of a 50 basis point hike already after the release, and the latest comments from the Fed official are telling us that they're seriously considering that. So the Fed has about 2 weeks till the blackout period starts before the March meeting. So I think we will hear much more from the Fed officials in the next couple of weeks, just to see how they are reacting to the latest CPI data, which was quite surprising to the upside, and it was broad-based and in certain categories that are, very important for the U.S. consumer.
So is this, it's not a surprise to hear hawkish tones from Jim Bullard, right? What happens when the next Fed official, one who's maybe more dovish, comes out and says, we're not going to do 50 basis points at our first meeting back?
Well, the markets will move on that, but I think the Fed is seriously considering, what they're going to do at the liftoff. So they are data dependent, and the data are telling us that things are moving in the wrong direction in terms of inflation. So the January report exceeded expectations, and it was concentrated in shelter, not only in certain things such as could be, Omicron related, but we will see that inflation will continue to push higher in the services sector, driven by shelter costs, driven by reopening of the economy. And we still see a lot of price pressures in the goods sector. It's not abating as much as we would like it to.
So it's not terribly transitory, is what you're saying. What are we going to see at the end of the year, Yelena?
Sure. So there will be some transitory component to that. We do expect inflation to peak out in February, actually. So we do expect that to go even higher in February and then start moderating into the middle of the year, where we see that around 6.5%, and towards the end of the year, where we expect that to be around 4%, much higher than the 2% target that the Fed has.
One of the other interesting things, I think, from the Bullard interview, Steve Matthews from Bloomberg News putting this out on the wire, Jim Bullard says, as a general principle, I see no reason why you can't remove accommodation just as fast as you added accommodation, especially when you have the highest inflation in 40 years. Is it really likely that the Fed can perform quantitative tightening as quickly as it did quantitative easing? It doesn't really have, a COVID crisis behind it.
Well, at least that's not what they have been saying. They would like to do it in the background, just the famous quote, watching the paint dry. Maybe the paint will dry more quickly, but still they really want that to be on a back burner, because there's really much less certainty about how the markets will react to quantitative tightening than to rate hikes. They still think that the interest rates tool is their primary tool, and this is what we should focus on. And I think the probability of a 50 basis point rate hike has increased tremendously after today's report on CPI.
We hear, though, from a lot of market participants that QT could be much more painful. We went to 4 trillion after the financial crisis and came down, barely. I think they only got down to 3.5 trillion, maybe not even that far, before they went back up to 8. So is this a case of, we keep hovering near the high watermark, or does the Fed balance sheet ever have to come down?
Well, first of all, it will grow into the economy. The economy grows, so as a percent of GDP, it will go down gradually, even if you don't do anything, if you just keep it constant. But I think the Fed will do the passive unwind the same way they did before, maybe obviously at a slightly faster pace, so that they will set up the caps higher than they did in the previous episode, but just simply given the size of the balance sheet. But I don't think, active sales or things like that are in the Fed plan. They will start with interest rates, and that's going to be the primary tool that the markets really understand how they work.